Andy. My name is Jens Stephans. My first name is spelled J-E-N-S. The J is pronounced as if it were a Y. My family and I are all German. I prefer to be on a first-name basis with my adult students, and so I assume that's where we are right here, right?
Jens, forgive me, it was an abundance of respect, nothing more. So.
I know that. However, you are also welcome to call me Mr. Stephan or Professor Stephan. I don't really like being called Dr. Stephan, so I don't feel like I'm a doctor. But under no circumstances are you allowed to call me the names that my wife used to call me when she got irate at me, just so we understand each other. I am a faculty member at EMU. I've been there for 4 years now. I came from the University of Cincinnati. This is my third or fourth career, depending on how I count them. I was an engineer first coming out of school, went to work for GE. I did a MBA at Penn State University, went to work in marketing and in sales for Corning Glass Works. Went and had the opportunity to do the PhD and become an academic. Also spent a few years in the Army, and so I'm also a trained killer. I do teach accounting, both at the undergraduate and at the graduate level, and I do with a colleague, exec ed programs for various institutions, and that basically is accounting and finance for non-financial managers. Everybody, from what I've heard here, everybody understands what the topic is here tonight. I assume everybody understands why it's an important topic, and my understanding there is we've, like most governments, we've got some budgetary constraints, and what we're looking for here with this unfunded pension and health care obligation that we have is perhaps a way to not have to get to the point of cutting some core services if we can find a deal that will work here. The way I look at my role here, it's very much the same as what I do in the classroom here. And so there may be some redundancy here, and people may already know some of the stuff, maybe all of it that I'm going to talk about. But it seems to me that there may be some people that don't fully understand the economics of what it means to bond a pension obligation. The way I deal with this is I put together examples. I teach by example, and what I have prepared for you tonight is a couple of examples that will allow you to do a couple things. One is to understand the economics of why borrowing money might actually make economic sense, all right? And then probably more importantly, what are the risks involved, and can we in some way quantify those risks in a way that we understand it. And the second part of what I do when I do it in the classroom, I'm also going to do it here tonight, is any of the problems that we deal with are problems where we try to predict the future. Nobody pays us to predict the past. And what that means is that when we talk about what's going to happen and is the risk too high, does it make sense economically or not, those things are all crucially dependent on the assumptions that we make. And the way I deal with that in the classroom is with financial models where the assumptions are completely transparent and where the method or the financial analysis becomes apparent, okay? And so my task here is, the way I see it, is to try to make the issue here understandable to almost everybody in the room. I'd like to I will give everybody the opportunity to question and talk about the assumptions that are in here, and I can change those live up here, and we can see what happens to the economic benefits. I will explain and try to make clear what those economic benefits are, and then try to explain and make clear and quantify what the risks are. And I'm going to do this in two ways. I've got two examples I'm going to do. One is I almost invariably will lead into any kind of a financial analysis problem with an example that is extremely simple and compact, that where the arithmetic is transparent and we can talk about what is actually happening there and what the economics of that situation is. And in this case here, that's going to be the Village of Happiness. And then what I'm going to do is I'm going to set up the bonding issue that you're considering reasonably close to what it is, and do exactly the same analysis using the same vocabulary, the same format, and then we can see where the benefits come from, what the magnitude might be of those benefits, and then finally we'll get to trying to quantify the risk. Okay? So that's where we're going to go, and I think if we can, I assume that everybody has the handout here on the Village of Happiness, do we?
All the commissioners do.
Okay. Okay.
You're not there. There you go.
Is that better now? Or? All right, I'll talk a little bit louder. All right, so if you just take a look at the screen, I assume you've got this in front of you. And so here we have the Village of Happiness, and they need to make two $1,000 payments each of the next 2 years to their retirees. And the village elders would like to understand the pros and cons of funding this liability with debt. And so they hired an obscure professor from the University of Happiness to explain the economics of such a transaction. Okay? And the way I do these spreadsheets, the cells that are shaded in blue are invariably the data cells, and those are the things that we can change. And what you've got in front of you is, I believe, the one where that I've got up here now. And so what we've got is we're going to borrow some money at 4%. We're going to make an assumption about some investment returns. We're going to figure out how much money we need to borrow, and the amount of the pension obligation is given as $1,000. What I would encourage you all to do, and the audience too, is if you have questions or comments, feel free to interrupt and deal with them in real time here, okay? And so we have a pension obligation in year 1 and in year 2 of $1,000 each, and our village here can make those payments if they want. The alternative is they can borrow some money, and the amount of money that they borrow needs to be $1,808, and that comes about from the assumed rate of investment returns, okay? And that is what describes that. So, for example, if instead of making 7% on our money, we're going to make 8% on our money, we're not going to have to borrow as much, okay, because we're going to make more money on the investment, and this will show that. And so now if you compare what you have in front of you, which is the baseline case you'll see up on the screen there, with an 8% return, we only need to borrow $1,783. Okay? The economics of bonding this obligation is as follows. If we borrow the $1,808 right here at today at t is equal to 0, and then we make some principal payments, okay, we end up owing zero money. We have to make some interest payments. The interest rate is assumed to be 4%. We make those payments. We get some investment returns, and then we have to make our $1,000 pension payments. And if we add all of those numbers up over the 2 years, what you see is that we make, by borrowing the money, we end up paying out a total of $1,918 instead of the $2,000 that we would pay out without the bonding. And so the benefit to the bonding is the difference between the $2,000 and the $1,918, which is $81, $82, and it comes about from the assumption about the investment returns. All right? That is where the benefit comes from. If, for example, you borrow at 4% and you invest at 4%, what do you think the benefit is going to be of bonding this thing? There is not going to be any, right? And so that is the crucial assumption in this whole thing. This is how the economics behind it works, all right? And this is how the economics is going to work for the question that is before you, okay? And so I'm going to put together, go ahead.
Excuse me, a question for Commissioner Robbie and then a question for
Yes.
Commissioner Schmidt.
Go ahead.
So when you changed it to being 4% and 4%,
Right.
what you're showing is that there's no benefit, but is there a downside to it being equal? It sounds like you're coming out at a wash.
Yeah,
I mean,
if I
you're paying
borrow at
exactly
4
the
and
amount.
I invest at 6, I got a money machine, right? The more I borrow, the better off I am.
If you
But the risk is, can I guarantee the 6? And the answer is obviously no. Okay? Unless you've got some fixed income securities that you can invest in, you can't guarantee the 6. And that's where the risk is, and that is the thing that we need to try to quantify.
Right. So, but what I'm getting at is if you're not making that 2% spread and you're making a 0% spread, you're coming out at a wash, basically.
Exactly, yeah. Exactly.
That's what I was asking.
That's the underlying economics of it. Okay? If I borrow at 4 and I invest at 3, my benefit is negative, right? It's going to cost me. So it's a good question in the sense that you want to understand that the benefits of bonding this thing arise, at least in my modeling here, entirely from the spread between what you borrow at and what you invest at. And that what you invest at is going to be an assumption, okay? And that's where we want to be able to, when we look at your problem, see what is the effect of different assumptions.
Commissioner Smith?
Thank you. The question I have is agreed to Jens. Is that what we?
That's what we agreed to.
And
yes.
then I'm Dan.
Okay. Nice to meet you, Dan.
So we'll go with that. What you've shown on the spreadsheet here is fairly typical. Plug in the numbers,
Right.
run through the exponential formulas, and
Right.
outcome the data. What's your comfort level with this kind of? It's not really a straight line in terms of algebra, but it's you plug in one number, you get another number out at the other end.
Right.
Analysis compared to some much more complicated assumptions that while the first year we get, say, a minus 2% return on our investment, and then the next year we get a 1% return, and you've only got 2 years here in this simple example, but so your comfort level with a much more real-world type of occurrence where the returns go up and down versus what you're doing, well, I'm going to assume a long-term average over the course of 30 years of 6%. So what's your comfort with those different types of analysis and how that impacts the calculations you've done?
The next problem we do is going to be the problem you've got. It's modeled as a 25-year problem, okay? And when we talk about, and so we'll go through the economics of how this works with the assumptions, and then we will take the next look at what happens when those assumptions don't come true. okay? And we'll have it year by year for 25 years, all right? And we can stick in any assumption we want in any year about what the market return is going to be that year, and we'll see immediately how that impacts the benefit or non-benefit. Do we make money or don't we make money based on the assumptions about future returns? So we'll get to that one.
Jens, please proceed. Thank you.
Okay. All right. So I assume that we're good here with our simple little example, and you know, this is the arithmetic that's going to underlie exactly what we're doing here with you. And so if you go forward in your handout, here are my assumptions in line 9 over here. It's the pension and healthcare liability payments without the bonding. And they go from approximately $31 million in 2014, and they go for the next 25 years to about $24.6 million or so in 2038. And those are the obligations that presumably you have to make, and I understand that those things will change when you get updated information from the actuaries and things like that, but that's not where my expertise is here, okay? We can make that set of numbers any ones we want, and this thing will work. So that is alternative A. You make those payments without bonding. Alternative B is to borrow money, just like we did in our Village of Happiness example. And in this example here, we're going to use, again, a 4% borrowing rate, a 6% rate on investment returns, and the compound interest mathematics tells us that given the 6% rate, we're going to need to borrow about $350 million. All numbers are in millions here, okay? And just like I did in my Village of Happiness, all right, the benefits of the bonding, given this set of assumptions, borrow at 4, invest at 6 for 25 years for that set of cash flows, the benefits of bonding are about $118 million. All right? So I'm in the same ballpark as the report by the consultants that you've had, okay? Numbers are not exactly the same. They know more about the details than I do. I do the financial modeling here in the sense that allows you to see the economics behind it. So the total is $118 million, and what you want to be aware of here is a couple things. One, let me scroll down here. Over here, when I get down to this part over here where it says bond issue, here's what happens to in this line over here, what happens to the principal on that bond. And what you want to see is that regardless of what assumptions we make, when we end up at the end of year 25, we have to have paid off that bond, right? So the balance there has got to be 0. That is one of those checks I use to make sure that my spreadsheets are working properly. Using the same format that I had in my little Village of Happiness example, I've got principal payments, I've got some interest payments, I've got some investment returns, those are 6%. We've got the pension and healthcare liability payments we have to make, and we've got a net cash flow from the bonding activity. And what you see is that in year 1, in year 2014, if we don't bond it, our payments are about $30.8 million. If we do bond it, the payments are $23.8 million. And we've got a benefit of bonding in the first year of $7 million. And that kind of gradually goes down over time. Part of the reason that happens is that the input to this thing is, again, from the consultant's report that I saw, they had a line there called debt service, and what's happening there effectively is that we're making smaller principal payments. The assumption in here is we're making smaller principal payments earlier and larger ones later, and that's part of where that $7 million benefit comes early, okay? So if you look at the principal payments later, and principal in year one is $4.6 million, and when we get out towards the end of this thing, you're making principal payments of $25 million. Okay, so in some sense, you are delaying the payments here. Okay? You're structuring this thing, at least in the way I've seen the numbers here, that you're going to be making smaller principal payments earlier, bigger ones later. And that's part of where this early benefit of $7 million comes from. So let me stop there just for a moment and ask for questions.
Questions from commissioners? Commissioner Smith?
Thank you, Andy and Jens. So the fully worked example here, you didn't model a couple of things you just talked about in the Village of Happiness, because they're making the full principal payment immediately in each of these years, whereas the actual model that we're working under, we're not doing the amortization on the principal amount and making that full principal payment in the first year.
Yes. The typical way we would model this is like a mortgage, right?
Right.
You make equal payments for 25 years. The interest is high in the beginning. The principal is lower. Those things change, all right? That's a different way to model this thing. The report I saw from your bond consultant had specific debt service numbers for the first 10 years, and my assumption was that those were chosen so that you would get some benefits to the bonding early, so that you would not have to cut the core services that are delivered to the community. You're going to make up for it later.
Right. I think the desire is that as we anticipate long-term property tax revenues slowly increasing, we want our payments to kind of match so that we have curves that are much more in line with each other. As revenues continue to increase over 25 years, our payments on the bond also continues to increase over 25 years, and we would have this additional funds to presumably make those payments. That's kind of what we're targeting here.
Right.
The other question I have for you on your model, and I guess this one does show up in the Village of Happiness, is how would we construct things so that over the 2-year period, or in this case the 25-year period, that total benefit ends up being zero when we're all said and done? Because this is a cash flow management, as we're talking about here with these principal payments, as much as anything else. And we really, at least I'm not terribly interested in coming up with a $118 million benefit when it's all said and done. I'm interested in managing the cash flow problems that we have right now. On your first example, the $3.8 million, or the $30.8 million versus the $23.8 million. That's a $7 million cash flow difference in 2014. That I'm interested in, because that impacts the services that we can deliver in 2014 and so on. I'm not so interested in getting at the end of 25 years and being up $118 million. So I'm wondering how we would model that type of thing so that we end up at zero over the 25-year period.
I mean, the only way that you will end up at zero benefit for the 25-year period is if you invest it for and you borrow it for. Okay, so
we've changed the cash flow, though we've not paid as much principal early.
Sure. And if the assumption is that you invest that for, in my model, the benefit is zero in every single year then. I cannot model I don't have the ability to model, the way I've constructed it here, the question that you're asking. I understand the answer, or the question, yes.
Thank you. I'm going to go to Commissioner Sizemore in a moment here, but Commissioner Conan Smith has a question related to Commissioner Dan Smith's question.
Actually, Dan and Jens, I think the simple way to model this is that the intention is the benefit accrues to the general fund. So you could simply put in a line that says general fund expenditure, negative $7 million, negative $6.9 million, negative $6.9 million. And then at the end of the year, or the end of that column, you'd have, instead of 118 million, you'd have 0. Because in your model here, that 7, 6.9, whatever, doesn't actually get reinvested into the bond system at all. It just accrues externally.
Correct.
Thank you. Commissioner Sizemore?
Thank you, sir. Hi, thanks for coming tonight. I got a couple questions. Isn't the rule of thumb about every 10 years the economy kind of falls apart? Is that?
I'm not sure what that rule of thumb is, but the economy has fallen apart in the
Okay,
past, yes.
so we're going to do 25 years, and I think the last one was 2008. Right. So we've got at least 2 times in this period that we're going to be sweating and figuring out what we're going to do. Right. Okay. Next thing, does inflation fit into these payments at all? At the end, I noticed we're going to pay more, but does inflation help us or hurt us on the back side?
All of there's 2 ways to do the long-term financial modeling for either capital budgeting or personal financial planning, whatever it is. One is to use the nominal rates that are out there. Say, here's what I can borrow at from the bank today, and that's got inflation embedded in it. Okay? So the assumptions and the rates that we use, when we use nominal rates, include the effects of inflation. We could do it in real dollars, all right? And some particular models like personal financial planning where you're concerned about the power of consumption that you have, the consumption value that you have, there it makes sense to do it in real terms. Most of the time we do it in nominal terms.
Thank you.
And your question about the comment about what happens to the economy, that comes in the next tab when we look at what happens over 25 years to the expected returns, okay?
Thank you,
that's
sir.
where we're going to be able to have a discussion and be able to see what happens when we make some assumptions that bad stuff's going to happen. What happens to the deal?
Thank you.
Thank you, Commissioner Sizemore. Jens, please proceed, and thank you.
All right, so just like in my Village of Happiness, you invest it, you borrow it for, invest it for. There are no benefits. The benefits come about from the assumption that you can have a positive spread between your investment returns and your borrowing rate. And unless there are other questions on the specifics of how this particular model now works in your situation, I think it's probably appropriate to go to the risk part of this thing now, because there is no free lunch, all right? We're not guaranteed this 6% here. The assumption, I would think, is that the money is invested in the stock market. Not sure that it would be invested in the bond market, because if you're borrowing and then investing in the bond market, it offsets itself, all right? And you will almost by necessity have a negative spread there. And so investing in the stock market is risky, and here is how we deal with the risk. If you take a look at the screen here or on your handout, I now have a set of blue cells over here about year-by-year investment returns. Okay? And when those are, and all of them right now are 6%, and so this is the baseline case again. The benefit is $118 million, is it's exactly the same thing that we had before. Now, we can make some assumptions about what kind of bad stuff can happen. All right, and I will take a suggestion from anybody. Give me something bad that happens in a given year, and I'll put it in here, and you will be able to see up on the screen the benefits of bonding and how that goes down when something bad happens.
Jens, I should warn you, you've opened up quite a box here. Commissioner Conan-Smith.
So before we read too much into the negative potentials relative to the benefits of bonding here, I also want to inject into the conversation that market downturns also affect the alternative to bonding. So right now, for example, we pay our pension liability in part off of a large accrued fund in WERS, 100 and X million, 160. No, how much is in WERS right now? So, which we assume will also earn a rate of return at 6%. So a market downturn impacts that model in a similar way to that it impacts this model. Therefore, just applying a market downturn to this model will show a disproportionate impact on the benefit of bonding.
Let me see if I understand what you just said. You've got another fund that's being invested that is being used to pay a different obligation, though, right? Or the
same obligation. So in the Village of Happiness, the pension liability payment right now is in part made from that fund, which is earning 6% or whatever.
And so, yes, you're correct that assumptions about what happens in the future to market returns, impacts that fund that you just talked about. It also, if a market downturn is correlated with a depressed economy, it can affect your tax receipts, your valuations and property taxes and all of those kind of things, and they can all go in the same direction together. But they will happen. If they happen in this model, they will also happen, like you said, in other parts of what you're dealing with.
So what we're going to see when you put a bad number in here, I'll give you one, say 0 in 2014, you're going to see that benefit of bonding decrease in your model.
Yes.
However, what you're not going to see in this model is what would happen to our baseline in the same scenario.
Well, your pension liability over here, the 30.8 million and 30.4, I'm assuming that stays constant regardless of what happens to the economy.
Yeah, John's saying no.
Not right?
Because of that 160 million.
Calculation is done. Mr. Axe, would you be kind enough to just come up to a microphone? No, that's all right.
There we go. The calculation's done. Those numbers, the liability that you have to pay in each year is calculated, and it gets smoothed out depending what happens to the stock market for the money that you already have. And so it can go down sharply, which it certainly did a few years ago. You don't have to pay that immediately. It's smoothed out. The actuaries will explain that. I think the actuaries are going to be here a little later tonight, I think.
He's here.
So they'll go through that. But that's I think, what Conant is talking about.
That fund is cognizant of the market return of this 160-some thousand. So it too is variable, which isn't really reflected in this model, which I totally accept. I just want to make it clear to folks that even though that benefit of bonding number is going to change and it's going to look dramatic, there are other factors that we would have to consider to do a thorough evaluation.
And that is exactly right in the sense that, when you bring somebody like me in from academics, I don't have the institutional detail that John has got And, those details like that, especially without having, if I sit down with them and talk to them for a week, I might capture some of that, all right? But, you see the simplifying assumptions that we make, and that goes through all of this. Okay?
Jens, thank you for answering that. Thank you, Commissioner Smith. Our other Commissioner, Dan Smith, had a question.
Yes.
I was going to suggest so I agree with with the point Conan's making in your explanation, because the WERS board does indeed assume a rate of return, and those are invested in equities and municipal bonds and so on. And the assumption is that this portfolio would be a similar portfolio to what might be in WERS, perhaps a bit more equity laden, as you point out, probably more blue chip equities, dividend paying equities, and so on, as those tend to be less volatile. But Conan's point's right. But you also mentioned something that is quite interesting as well, is when we actually start to think about other variables, this model starts getting extremely complex. You mentioned an economic downturn and all the things that we would have to consider in an economic downturn, the number of people that are currently in our pension plan that might retire or might choose not to retire in an economic downturn, which impacts the actuarial reports. You mentioned it impacts the tax receipts, which impacts our ability to pay from the general fund into those things. So the model starts to get extraordinarily complex when we start adding in all these other factors. And I'm sure you could probably have one of your students publish at least a couple of papers, if not a big, thick book, trying to model all this together. Maybe some of them have, or something like that. I was going to offer a number. Let's do something in comparison to what happened in 2008 or 2009 with a broad market, given that it's a mixed portfolio of, say, a 15% downturn followed by a 10 or a 12% downturn, something like that. So let's say 2008, 2009, 2010 repeats itself again before we start getting an upswing.
So I'll start with minus 15% in 2015, okay? And the benefit right now, baseline benefit is $118 million. All right, we get one bad year, benefit goes down to 54. All right, we get another bad year, you want to minus 10. Okay, and now we're pretty close to break even. Okay, and so this is one way to try to quantify what the risks might be here, okay, in terms of the assumptions about borrowing at 4, investing at 6, and what kinds of things can go wrong so that you end up not making money on the deal anymore and possibly losing money on the deal. Okay, so this is one way to do this kind of risk analysis, is to hypothesize about things that have happened in the past and will they happen over the next 25 years here, and what's the impact going to be.
And, if I may, and to be fair in putting some of these hypotheses together, that starts to be complicated too, because these aren't just random numbers that we pick between a range of, say, minus 15 to plus 15. What happened in the past certainly influences the likelihood of that happening in the future. It's unlikely we're going to see minus 10 and then jump up to 6 and it be flat for 6. It's probably going to be more of a smooth up-down, and then we're going to go 8% and 10%, and we've seen last year 11%, and then it's going to maybe stay steady at those rates or come down. And so that, trying to guess at how all that might turn out, starts to get extraordinarily complicated.
And there are as many assumptions about the future returns in the market as there are people sitting up here, probably more than a number of people. And but this gives you one way to quantify what happens when bad stuff happens out there in the market, okay? And gives you a sense for what the risk might be. And, we can put any kind of scenarios in we want over here. We'll get different numbers for it, and but you can see that it's fairly sensitive. I mean, you got 25 years, and here you got where 23 of the years, everything goes exactly the way you planned. You got 2 bad years, and you basically lost all the benefit.
Jens, on that? Oh, Commissioner.
No, if we want to continue this, or do you have something else you want to say?
Please continue, and then I'm going to call on Commissioner Martinez-Kratz and then Commissioner Conan-Smith.
One of the things that I have for my personal finance, my company offers it through Vanguard, is they partnered with Financial Engines, and I'm not sure who the doctor is that's behind that, but I've read through some of what they try to do, and they do a very sophisticated Monte Carlo analysis, trying to put some of these things that we're talking about into play and run through thousands of scenarios with a Monte Carlo analysis and say, X number of them ended up here and X number of them ended up here, so that you don't have just this straight line, let's assume a 6% return for 25 years. And my question to you, Jens, is do we have ready access to that type of analysis, or is that extremely expensive software and requires a large amount of expertise to use? And what I'm using on their website is very specifically targeted for a personal financial situation, not this type of situation.
What you need there is what I'm pointing at up here on the screen, which is called crystal ball. Crystal ball, it used to be a separate company, engineering something or other. It's owned by Oracle now. My understanding is the system costs about $1,000, probably more by now. But I know Mike Frandon, and so I get it for free. And that's what we're going to do here in about 10 minutes.
Thank you very much, Jens. Thank you, Andy.
Sure. Commissioner Martinez-Kratz?
I don't know if I'm going to exactly articulate this right. We've been talking about bonding at 4%, which is great. And I noticed your last page of your document talks about S&P minus 10-year bond rates.
Yeah.
Isn't the county, if we bond at 4, the current 10-year rate, we would be taking a 25-year bond, so we would be paying maybe a percentage or a half a percentage, maybe this isn't your expertise, but above the T-bill rate. Am I correct?
We're going to go there. The 4% number came from the consultant's assumption about what the interest rate would be.
If you're going to go there, what kind of fees, as I'll call it, or bonding fee, or that you'll have to pay yearly for that gap?
That's a good point. I do not have any fees built into this model for issuing the bonds. And they can be significant, but I don't have that embedded in here. I could deal with it on an ad hoc basis by assuming that the investment returns are net of fees. Well, they'd be net of management fees, but not net of the bond issue fees. I do not have bond issue fees embedded in here.
Okay, but what'd you say about you don't have fees for...
Okay, so if you do this thing, you're going to have a financial manager of some kind that's going to manage your portfolio, right? And that person will get a fee.
Yeah.
Okay, and so when I have investment returns here of 6%, the assumption is that 6% is net of the fees.
Right.
Okay, it includes payment to the manager for the fee for managing the portfolio.
My question, so you're just plugging in any assumption, not really relevant to your chart in the back that the.
We're going to get to that one shortly. That one goes. That's where we do a more sophisticated analysis of the risk.
Okay, thank you.
Thank you. Commissioner Smith.
Sure. Right. In what year? Okay. So minus 22. Okay. 215. Okay. Next one. Next one. approximately where we are with the flat 6 average. But remember, the last 15 years are still +6, all of them. But what you're getting at here is correct in the sense of having a better way to try to quantify the risk and relying perhaps on historical market returns to argue if they repeat themselves in the future, what will happen? What's the probability that we will be successful, will make money or not make money on this? Okay. And that gets to what Dan was saying about the simulation.
Thank you. Jens, please proceed.
So I think we've exhausted what we can do here in terms of the risk analysis. Anybody can plug any numbers in they want. You can see it and, I'm sorry? Yeah, absolutely. I mean, and it's a good, I use it as a tool to play with. And you can put in your own assumptions, and it gives you a sense for how things work together. Okay? It gives you some benchmarks to how sensitive things are. Okay? All right, so as Dan said, we need to do a better job on our risk analysis here. And so this is not part of your handout. And so what I have up here, if you look at the screen, I've got S&P 500 returns from 1928 to 2012. All right, and we've got, I get those from Aswat Damodaran at NYU has got a website that's got a bazillion things of data on it of almost anything in the world of finance you want, and that's where I go to get this stuff. And I also use the 3-month T-bill rate here, okay? And I calculate something called the spread. It's the difference between the S&P 500 return and the 3-month T-bill. And the argument here is that that 3-month T-bill represents what someone could borrow at that basically had no risk, which would be the federal government, okay? So if you could borrow at that rate, then the column I've got up there labeled spread is the historical return that you would have earned, okay? And that historical return would have been, spread would have been something like 7.5%, okay, per year. And that's a simple arithmetic average, okay? And that comports with at least my understanding of what market returns and stuff have done. But it represents the average spread that you would have earned over the last 85 years. The question, I think, that we ought to be asking ourselves here is, if we do this, what is the probability of success? And there's some assumptions that go into that, okay? One of the assumptions is that, and we have nothing else to work with, okay, at this point, what if history repeats itself? So what if history from 1928 about this spread all the way down to 2012, okay, if that thing basically repeats itself. Now, we've only got a 25-year project here, okay? And so the way that we model this thing here is we say to ourselves that in year 1, we're going to let this crystal ball pick a random number from those 85 returns, okay? And in year 2, it's going to pick a different random number, okay? And it's going to do this thing 200,000 times, okay? And what we're going to see then is that some of those times we're going to, we expect the market returns to be positive on average. They are, okay? So when things happen in the same probabilities and things that they've had in the past, we're going to be okay on this. But the question is, what happens when a bunch of bad things gang up on us over the next 25 years. What's the probability of that happening? So if you accept the premise that the spread column over here, okay, is the difference between the market return and what the federal government was able to borrow at in each of those years, okay, and we sample from that distribution repeatedly for 25 years, okay? Question is, what is the probability of success? And that is what we're going to do right now. If you look up there, you'll see it. And for those of you that have been business majors or engineers or something, you know, we got the law of large numbers, and everything is close to normally distributed. And what this here tells you is that there's a 90% chance, that's the area under the curve in the blue, all right, of being successful, okay? Which isn't bad.
Commissioner Smith?
Success is, okay, my apologies. I have redefined this thing not in terms of the dollars. I've redefined it in terms of beating the spread being positive.
The spread being positive.
Okay?
Okay.
So you borrow at 4, and if you hit 4 or more on the investment on average, that's the number that's in here. That's why 0 is the cutoff. Good question.
Thank you.
Yeah, Commissioner Smith, thank you, because I think it's a point to highlight that the intent here is, as has been said, an issue of cash flow, an issue of providing services, not trying to make money. It's just not our function, nor should be, nor ever will be. So thank you, and thank you, Jens, and forgive the interruption.
All right. So 90% sounds like you've got a pretty good chance of being successful in this thing, in being successful. The problem, of course, is that you can't borrow at the same rate that the federal government borrows at, right? And so you're going to have to beat this thing, but you're going to have more than 0, okay? And so right now, I looked at this morning, the 3-month T-bill rate is 0.04%. I've got that up in column M up here, okay? And then I've got another data item over here. What's your borrowing premium? Okay? And somebody suggested a number, but was it 1% or
2%? Let's keep questions to commissioners right now. That's a great one, but
Right.
Jens, what's a realistic number we can plug in there?
Well, I mean, right now, the assumption that I've seen in the, I don't know what the realistic number is. You know, that is too far along the institutional side for me, okay? But the piece of information that I have is what was in the consultant's report, and they assumed a 4% rate. They may have been conservative, I don't know, and may have overestimated that a little bit. But, you know, getting a reasonable number is something that these guys would know and I don't, okay? But I can model this thing and tell you what, for example, now the probability is if the premium is 2%, okay? So you will pay 2% over the T-bill rate, okay? And if we model that and we run our Monte Carlo simulation, now all of a sudden the probability of success drops to 80%, okay? And now, and I don't know what your risk preferences are. I can't tell you what they ought to be. I can't tell you what the number is that you ought to feel comfortable with. But here you've got a tool that can be used in a reasonable way for a simple model that does not capture all of the institutional detail to try to estimate quantitatively what the risks are in bonding versus what the risks are in doing the bonding.
Commissioner Dan Smith?
Thank you, Andy. And to Conan's point from earlier, this same thing would presumably apply to our existing pension fund, and what is the risk that our unfunded liability is going to continue to increase, or that we'll be able to work that liability down through higher than average investment returns, right? That same analysis could be done looking at just that existing balance that we were talking about, and Conan brought that point up earlier, right? And you agree that that is true? We could do
Sure.
similar assumptions and similar types of calculations. To be fair,
I am looking at a slice of what you're dealing with here, okay? And things are interrelated, and that's your job to think about those. But if you can describe the financial problem, it can be modeled, okay? So, obviously, the bigger the premium is at your borrowing rate versus the federal government, the lower the probability of success of the project.
Commissioner Robbie, you had a question?
I think you actually just answered it. I wanted you to explain in more detail what the borrowing premium meant, but I think you just said it.
You can't borrow at the T-bill rate. Okay, I don't think you can borrow at 0.04% right now. You're going to borrow at something higher, and I don't know what that is. That's too far along the institutional line for me. I can do the financial modeling to tell you what the effects are of your borrowing rate.
Commissioner, go ahead.
So, but this is a different number than the estimated 4% in the plan. Okay.
We're dealing strictly with risk now.
Right.
And trying to quantify that in a meaningful way.
Yep. Okay, that makes sense now. Thanks.
Commissioner Cohn-Smith?
Andy, do you mind if I bring John back into this dialogue for a moment?
Sure.
John, the coupon rate schedule that you guys presented to us, we're talking about this 4% borrowing rate, but the coupon rate is actually pretty variable. And
well, actually, the 4% is the average over that's your average net interest cost on a 25-year issue. And you have to understand that we're not issuing 90-day paper here. We're issuing 25-year bonds. So you have to compare your borrowing rate with the Treasury borrowing rate. And you are higher than Treasury, but not by a lot. I mean, we can give you some numbers on that. We haven't.
Oh, I see. Yeah, right.
We got to compare 25-year governments to 25-year Washtenaw counties. That's what you have to compare. You can't compare in the short market because it's a totally different market. And we're not suggesting, incidentally, nor would we ever suggest that you ought to do floating rate obligations.
Right.
Ever. I mean, you do for short stuff, that's fine, but not for a 25-year issue.
In the schedule that you provided us, there's a coupon rate in 2015 of 2% and a coupon rate in 2038 of 4.4%.
That's right.
So
it's a ladder going up, which is the standard yield curve, and that was based on numbers in January, February, March of this year for similar credits to yours.
But I guess I'm trying to understand the 4%, where 4%.
4% is just if you calculate a net interest rate for the whole bond issue, that's what you'd end up with.
I thought I did that and came out with 2.9 using your. I did it wrong. You can say that.
No, it's what we it was just a shade over 4%. We rounded it at 4. And when we get to the point of actually getting ready to sell the bonds, we'll have a much better idea of what the actual rate is. And bond rates go up and down too, like everything else. They don't go like the stock market, fortunately, at least not ordinarily. So we don't know exactly what the rate will be by the time you get ready to sell. But interest rates, as he's pointed out, long-term interest rates today are at the level that was experienced between 1935 and 40. I mean, just like the short terms are. And so you're above treasuries, but you're not way above, believe me.
Okay.
It's remarkable, and the spread, you know, it moves up and down somewhat, but there's a great deal of demand for high-grade municipal bonds, which you have, as you know.
So in Jens's model, in your model, the 2% premium should be sufficient spread, even recognizing that we're talking 3-month T-bill versus...
You aren't going to be too well. He's used a different model.
Right.
We'd have to use a model which took in account the long-term rate rather than the short.
And that,
But which we can do. I mean, you know, or you can do. Anybody can do that.
I can't
one
do
thing,
that.
one thing you have to remember is you've got to have good investments. Your current investment assumptions are a good deal higher
Right.
than where we are right now. And I don't know what your actuary is going to end up with when the report comes out, and they probably don't know yet either. But I have a feeling it won't be as low as 6%. That's just an assumption. That doesn't mean what it's going to be. But
good to be
you made the
conservative.
point, and it's up and down if you're investing in the stock market. There are good times and bad, and you're spreading it here over a 25-year period too. Anyway, that's.
John, thank you, Jens. Thank you for letting me do that.
Thank you.